Mr. Kashani,
Are we good?
you're good to go.
Okay, thank you, Mark. Or lack thereof. So good evening, and welcome to the Finance Governance Meeting. Let's call the meeting to order. And our first topic tonight, item 2.01. I'll turn over to Mr. Tony Massidi from PNC Capital Markets. And Tony, would you mind presenting that overview of the current bond market and any debt reimbursement opportunities we might have?
Okay, thank you. Make sure this is on. Everyone can hear me. Thank you, Mr. Kashani. Thank you, and good evening, everybody. And thank you for the opportunity, as always, to present to the district and take care of the district's indebtedness and its financing needs. And thought it was a great time to present a quick market overview, especially with some newer members of the district's board. A little bit of background on the district's financings over time that have really provided the financing needs to build out the district, especially through significant growth period that it went through really in the kind of through the late 90s and into the early 2000s, and then the opportunity to actually take advantage of the market, very benevolent historical low markets that existed circa 2010, 11, 12-ish that really ran through 2021. 2022 was a very quiet year in terms of the district's refinancing opportunities, and that lingered through 2023. Main reason being, if Mr. Jesuit, if we switch to there, those pages tell a quick tale. And really what we're looking at here is increasing rates. If you see the left side of the charts, in the upper right-hand chart are the two kind of proxy indices for tax-exempt rates and taxable rates. And that upper right, that's 5-year maturity. The 10-year maturity is the lower left, 30-year maturity being on the lower right. And if you look left to right, you can see really where rates began to take off based on the Federal Reserve raising the short-term interest rates, the Fed funds rate. And that's kind of the basis or the foundation of all other rates to start taking that signal that rates are headed higher. They did that really as a combatant to inflation. They needed to there was a lot of money in the system. Inflation was coming up very, very quickly. And in order to keep that at bay as best they could, one of the levers that the Federal Reserve has is to raise the short-term interest rates, and then that becomes the basis for all other interest rates. So as shown there, we not only rose significantly, we rose very rapidly. This was a quick turnaround in the increase in interest rates. So how does that impact the district? That kept your refundings basically out of the market. Now, that's a very good thing because that says that the district's debt portfolio was financed at very low interest rates. To give you a good statistic on that, we can actually, and if we just go through, I'll mention where you're at. You're significantly below 4%, and we'll get to that chart later in the book. But if we flip to the next page, you can see what's happened. We've seen a very flat yield curve at these higher rates, which basically, and even in the shorter part of the yield curves, we're still inverted, as indicated by the two charts on the bottom of this page 4. And on the left is that's taxable rates. On the right side, in the green bars, that's tax-exempt rates. The district's indebtedness is based off of the tax-exempt yield curves on the bottom right corner. And you can see that the red dashed line is where we were a year ago this time, so early 2023. And that red line is about 200 basis points higher than we were January of 22. The Fed and all the interest rate implications really kicked in February, March of 22 and ran straight through last year. So when you're thinking about where would we have been in that time period, heading back into late 2021, when the low historical level of interest rates were really hanging around, we're about 200 basis points plus over those historical lows. So that kind of explains why there were no refinancing opportunities for the district. Plus, you have to time out your call dates, your optional redemption dates on each piece of debt that the district has outstanding. That was due to a tax law change in 2017 that took effect January of 18, where you could no longer advance refund debt with tax exempt. You would have to go taxable, which has, obviously taxable rates are higher than tax exempt rates, so that takes away some opportunity. But the district has historically maximized its refundings through current refundings. So that tax law change didn't really impact the district as much, but what really impacted the district was more the level of overall interest rates. So if we flip to the next page, another thing that really drove rates, investor demand. So where was investor demand? While this is a very busy chart, anything that's above the line, that means money is flowing in to fixed income. Investors are demanding tax-exempt debt. Anything below the line is when money is flowing out of fixed income, municipal securities, and that drives rates. The more investors that are looking for fixed income, it's supply demand. Rates go lower, the more investors want the paper, the municipal securities that are being offered. We saw historical outflows in 2022 to the tune, as it's shown there, to the tune of about $145 billion on the bottom. 2023, we stabilized a little bit, but we still saw outflows, net outflows, to the tune of about $21 billion that came out. So far this year, there's about $4.3 billion in the month of January that came back into municipal securities. So are we starting to see a turnaround? Those signs are all kind of pointing to that rates have plateaued, and investors are saying we probably want to start getting back into the fixed income market and maybe grab a hold of these higher yields because they might start to decline. Everyone is projecting that maybe we're going to see 4 to 5 interest rate cuts from the Fed this year based on the economy. If you turn on any financial network, even sometimes the evening news will be mentioning that recession is right around the corner. Probably have been in some kind of awkward recession, especially given the amount of layoffs, lack of hirings in larger circles that has really started last year. But you're seeing somewhat of a stagnation in interest rates right now, still at a little bit of an elevated level. But when they're predicting that we're going to start seeing all of the Fed interest rate hikes that are meant to tighten the economy, when we start to see those take hold, which really started kind of fall of 23 and we've already seen early 24, that typically will signal a reverse in this trend and a reverse in the direction of interest rates. So with that being said, the district may have some opportunities just over the dashboard should rates start to fall and come in. So if we flip to slide 7, this is the district's existing debt portfolio. And as you can see, while there's a lot of different shading on there, the district, with the number of issues that are outstanding, 12 in total right now, they have various maturities and various call options on them, meaning refunding opportunities. And right now, as I mentioned, you are at about a 3.63 average interest rate outstanding. So that is significantly low, given that right now, if you were looking to borrow money on a tax-exempt basis over a 20-year, 25-year period, that interest rate would be significantly above 4, closer to 4.5%. So the district is enjoying extremely low interest rates on its debt portfolio right now. There's two other key factors that are pointed out at the top right. About 76% of the district's indebtedness has a call feature on it, meaning not only has the district had the ability to take advantage of all the refunding opportunities from inception of the debt through today, it still can take advantage of those call features on the overwhelming majority of the outstanding debt. So there remains savings opportunities to continue to lower the debt service and or shorten the term, which the district has done historically. Round numbers, the district has taken advantage of refinancing opportunities to the tune of saving about over $800,000 a year over the life of the debt service, and knocking off approximately 2 years from the final maturity. So all those were key items in the district's rating, credit rating being in the AA category, and also propelling it with the ability and the flexibility to continue to move higher in that rating category as the district continues to maintain its debt portfolio here and its profile of shortening and lowering the annual debt service. And please stop me with questions as we go. Discussion is very, very welcome. So any questions, I know I'm breezing through this somewhat quickly, but I want to stay respectful to the district's other items on the agenda. So please stop me as needed. So if we flip to the next page, Mr. Jeswick, this points out the near-term opportunities from that bar chart on the prior page. And anything in green is either, some of the debt is non-callable, meaning it doesn't have that optional redemption date, it's fixed to its final maturity. The rest would have a call date that's a little bit longer in the future. So a couple have 2025, a couple, there's 2027 and 2029 and 2030 out there. So again, we continue to look at those as we go. But the main ones in focus are the ones that are shaded really in the blue. So the darkest blue is the main opportunity that we're looking at right now, which is the 2014B. That series is about $15.4 million and change. That's the one we're going to focus on for two reasons. We're approaching that call date this year, and the fact that that's a significantly sized issue with kind of, as you can see where the darker blue bars are, it's somewhat backloaded debt when you consider where all the bonds are maturing. That means you can really take advantage of the savings because that's where the accrued interest is coming off the back end of the bonds, and you're realizing that interest today. So if we can lower the interest on all those bonds in the back, that's where the savings is going to be realized. The lighter blue.
Hey, Tony.
Oh, yes.
Hey, Tony, Mark here. So just a question about that one before you go further. If I understand that that's a potential candidate, but if rates aren't favorable right now, then is it realistic?
That's a great question, and it's realistic from the sense of that we'll look at on the next page. It's close on rate. Here on page 9, if you look at the second line item, the series 2014B, and we go all the way over to the right under the green column, that tells us how much interest rates have to move for that to come into view, come into perspective. The district has typically wanted to see its savings efficiencies 3% or higher. If you listen to GFOA, especially school districts, smaller municipalities, they've typically set a bar of about 2% net savings. When rates were at historic lows, the district was significantly higher than that, right? The savings were reaching upwards of double digits, 10% savings, 7, 8, 9 as interest rates fell, and it lined up with the district's call dates. So that efficiency that the district took advantage of was significantly higher when rates were at historic lows, 2020, 2021, even some of the refinancings from like 2017. And as you can see, the 2017 issue, which is the first line item on page 9, if you look at the column kind of in the middle, that's another one of our gauges. Where is the remaining average rate on those bonds? The 2017 is already past its call date. That could be currently called. We were looking at that one in 22. But as rates rose in 22, as we approached that call date, it became an inefficient refunding, so it was not pursued. And that one is kind of set idle, but the remaining average rate is 2.58%. So would not make sense to refinance that one. And over to the right, we would need interest rates to move about 250 basis points for that one to reach a 3% efficiency. So that one matures in 2027. Not a lot of time left on that one. So that's one where it probably is not necessarily realistic that that one's going to come into view before it matures, fully matures. But knowing that that rate is at basically 2.5%, that's really low, you know, quote unquote free money, if you will, with rates being that low. The others that have the rapidly approaching call date would be the 2019A, the 2019B. And again, we need significant movement in interest rates for those to come into picture, to come into view, about, you know, better than 200 basis points improvement in interest rates. But again, because those are respectively the 19A at 2.18% remaining rate and the 2019B at, again, about 2.5% remaining average rate. Those ones a little bit longer in term, the 2019A September of 18, and the 19B has the longest of those at 2038. So is it more realistic that perhaps the 2019B might still have a chance to be refinanced for savings? Yes, because it has the most time remaining out of these candidates. But the 17s, the 19As, most likely they're at extremely low interest rates, most likely won't be refinanced. But as you can see in the Bs, because that remaining average rate is a little bit higher at 3.37%, we're only between 20-25% from it reaching that 3% efficiency level. So that's why that one is highlighted specifically this evening. And the table on the bottom of this page is a sensitivity analysis. And that tells us if interest rates were to move by 25 basis points at a clip, either higher or lower, what does that do to the 14B refinancing? Right now, if we move 25 basis points lower, we get over that on the far right, we get to about 3.4% net savings. So that puts that in, you know, in view for the district's targeted efficiency level. So that's the one we're focused on right now. Just to mention before we leave that page. Oh, I'm sorry. Mark, go ahead.
Well, Tony, I'm sorry. Go ahead. Finish your thought, and then I'll ask my question.
Oh, okay, sure. I was just going to finish on this page. The last line item is kind of the indirect indebtedness for the district's share of the A.W. Beatty Career Center. That piece of debt, the district only has about below $750,000 remaining on that. It will reach its call date this year. And again, that one, significantly low rate, 3%, not a long term remaining on it, fully maturing in October of 28. So not a lot of years left to really accrue savings on that. It's just out there. I mention it because it is out there. The call date coming up in 2024, and that you would probably need close to 300 basis points movement to make that efficient and work. And again, it's a very, very small piece of the district's overall debt service requirements. So that small piece being out there, something that if that comes up, yes, we know about it, it's out there. But that, again, that's the district share along with the other 8 districts that are part of A.W. Beatty. So it's a very, very small component of the overall debt that's remaining on that is the district's responsibility. So that's finalizing that page, Mr. Kashani.
Okay, thank you, Tony. So very helpful, and I do want to keep us moving. We have a lot to cover tonight. That was very helpful. The question I have is, so from a timeline standpoint, how frequent should we get updates from you? And just give us some insight for the benefit of the board, how often you're tracking the rate for us to get the kind of movement we need, and then when should we have you back to present again?
Yes, give you the call it the Cliff Notes version of timeline for bonding. What we've done is you're looking at about anywhere from a 60-day process from start to finish. It can be done as short as 45 days. You have to go through, number one, it has to be put before the board in resolution format that this is our intent, because you need to adhere to the LGUDA, the Local Government Unit Debt Act, under DCED. So you first need to bring that to the board. You need to have public notice that that's going to be included in a resolution. Then it's in the resolution. It's talked about ahead of time. The following meeting, you'll have that formally in as a voting item. And that would say, for instance, in this case, Pine-Richland School District intends to refinance the series of 2014B with a series of 2024 bond issuance that would meet the following criteria. That, obviously, the district holds all the power and the green light, if you will, on that if it does not reach that savings efficiency, the bond issue is not enacted. However, if it does reach your desired level of efficiency, then the district's administration can give the green light to proceed. Prior to that resolution, or in lockstep with that resolution, would be gathering all the information of the district, putting it into the offering document or the preliminary official statement that goes out to investors. And with that, you would need the public rating. So that's about a 2 to 2.5 week process to put together the documents, present them to the rating agency, have the rating agency do its review of the district, and then publish its formal rating, underlying credit rating of the district's debt. Once we have that, then we put that in the market. We put it on the street, is the terminology for investors to read and digest. And that's about a week to 10 days ahead of formal pricing. At that point, the bonds are priced. If the deal works, then the bonds are offered. They're put in the market, they're priced. And then under the DCED, under the LGUDA code, you need a waiting period of 20 days to make sure that all formalities are in place, that any questions can be answered at the DCED level of to the district if needed, and then you can move to settlement. But on the day of pricing, that's when rates are locked. So start to finish, that's anywhere from a 45-day to 60-day process.
So would having you back in March be too soon, or are you thinking April is better?
I think we're fine. Given the timing of when this deal is eligible, we could settle this in August. So I think if you back from August to have that prepped, July, June, I think April is a good time to give another update. And I can continue update Mr. Jeswick here on where rates have moved, really on a weekly basis, bi-weekly basis, just to make sure we're still, on the trajectory that rates are headed in the right direction. And probably the April-May timeframe would be perfect to be in front of the board again, to give a full update. This is what the market has done since our meeting in February, and we're either kind of holding serve, if you will, or it's looking like we have gotten back that 20 basis points and hopefully more, and so that the savings continues to grow and the efficiency continues to improve, so that, by July, the district could officially be pricing to settle in August, would be the first eligible settlement date. So you could be pricing the deal as early as June, July.
Okay. Why don't we, unless there's an opposition, why don't we just plan on April or May? And I'm not sure if we have any finance governance meetings scheduled. I just don't have that in front of me right now, but
We do. We have
we'll
a
talk about that during the.
May 6th, we have a finance meeting.
Okay, so why don't we plan on then to have him back?
Mr. Kashani, is it okay if he? Yeah, let's, the only thing we didn't talk about briefly is the termination of swaps that also happened in the last set of years, which improves our position. So it's just something to be aware of. It's already been addressed, but it is worth knowing if you could briefly cover that.
Absolutely, Dr. Miller. The district did.
Yeah, that's fine. I just want you, like, we're gonna run out of time. I'm just saying.
We only get Tony once in a while.
A very quick overview. The district did have a portfolio of interest rate management agreements, or swaps is the general term for those. And they were to accompany the variable rate indebtedness of the district, to synthetically fix the rates and or enhance the district's risk profile on those interest rate management agreements. The district was able to take advantage of the cash flow off of those agreements, and the district, as compared, sometimes you'll hear about districts that really didn't fare well with those through the 2000s, and as recently maybe as the mid-2000s and into the early 2010s, the district was not one of those. The district very, very tactfully kept all of its upfront swap monies received in a separate account and was able to benefit from that continued positive cash flow. Even as markets were volatile, the district was able to maintain their position by not having spent those proceeds and taken on greater risk. So from that allowed the district to go into a period of unwinding the remaining interest rate management agreements with its respective counterparties. And through that, the district is now completely out of those interest rate management agreements, which further enhances the district's profile with the rating agencies.
Yeah, so the hope is the next time a refunding comes forward, perhaps it will be the time.
Exactly.
Yeah. Okay.
Exactly, Dr. Miller. Okay. Thank you
Okay.
all for
Thank
the
you.
opportunity.
Thank you, Tony.
Thank you, Mr. Kashani.
Thank you, Tony. Have a good night.
Thank you, thank you.
All right, let's move on to item 2.02. Mr. Justwick, can I ask you to address the general fund budget and capital funding plan? And at some point, Chris, I just want to make sure we leave enough time for the capital projects update. So just help me, if we can just make sure we just leave at least 10 minutes for that.
Sounds good. So the first attachment we have on item 2.01, that is also part of our February presentation. We do attach this, remain consistent with what we've done in the past. This has this takes our PFM budget modeling and uses key assumptions to it. So I'm just going to go over the table of contents so everyone has the ability, give a general overview so everybody has the ability to navigate this on their own. We have key assumptions. That just explains the revenue and expenditures, what theories, what percentages, why we use these percentages and stuff and such through this model. As we go through the table of contents, concise general fund summary, actual budget, projections, once again, percentages we use and such. The overall general fund chart, this gives us information. What this takes is we go back as far as in this current model of 21, 22, and 23 actuals, 24 budget, which we currently have. We're still working through this 23-24 school year. It gives us projections all the way through 2029. as you can see, the deficits get more aggressive as you go along, but it is a very conservative model based on those percentages. So as you go through the flow, the rest of the table of contents with the long-range budget projections, once again, these are all separate. Custom expenditure display chart, retirement planning chart, that shows you how PSER's percentage rate affects expenses, and then the return we get on those on the revenue from the state, that 50% revenue. So that gives you a great view of how the retirement percentage works through our budget. You will see the real estate planning chart. That gives you the millage rate, where we have been very stable at since I believe the 2017 increase. So, and it also gives you the history of our assessment changes. As you will see this year, right now we have a projected, not quite the increases we had in prior years, very stable, and that's based on some of the assessment changes we have seen, which I will get into that in the general presentation. You see our capital planning chart, which Mr. Masidi just explained with our our overall debt, principal, and interest. From that aspect, one of the things that I mentioned on top of what Mr. Masidi mentioned, under 9% overall debt in our operating budget, which is one of the goals of the 10-year plan, stay under 10% in that debt area. The rest of it, you see some more pages attached to the general fund detail report, the expenditure by program report, as those are just general breakouts per line by line items. So that's good to review just to see how the expenditures are broken out per PDE's chart of accounts. Once again, our capital funding plan is attached to that. That's our 10-year projection. That was updated as of January, where we have a little bit over $11 million looking into the 24-25 budgeting season and capital expenditures. And then general reference materials that are also connected to the previous Finance Committee meeting in, back in January, where those are all related within that benchmarking. So if we can flip to the next.
I would just say with
presentation.
the detailed charts, if there's anything that pops out to you, you can call me or send me a question, or we have a school finance 101 kind of thing. So if there's anything you want to know about, just ask, and we'll be happy to talk through that.
Yeah, Brian, I actually went through a couple hours over the weekend on that, and I'm going to have a lot of questions. Just on first blush, right?
Yeah,
Yes.
I really want to understand better with how we're doing this.
Yeah, it's great. And PFM, and the benefit of PFM, that's a choice, is to have some long-range planning so we can look beyond what many school districts do, which is they're looking at the next year. And so even as Mr. Masidi said, boards, when refunding opportunities existed, some districts would take that as a way to take the savings to balance the next year's budget. And we have never taken that approach. It has always been a long-term approach, and that's what you see with the charts here.
No, it was good to see all that detail, and I appreciated it because it gave me, but I got to get some insight and understanding. I'm familiar enough with a 5-year plan, so I commend you for doing that too as well. But love to have some further conversations on that.
Great. Yes. Absolutely. So we're going to get into our proposed final general fund balance budget update. So overall, our Act 1 budgeting process on January 8th at the combined planning voting meeting, we certified, the school board certified not to raise taxes above 5.3%. That would increase our millage by 1.038 at the max, going from 9.5867 to 20.6247. Now, that is not a recommendation of mine right now. I think right now we are showing operational surpluses, even though even with making some of these capital expenditure plans, that does not make sense at the moment when your operational revenue is exceeding your operational expenditures. So on here, this is the draft proposed final budget. We have many unknown factors at this point: personnel costs, staffing projections, and we're also going into a contract negotiation. So usually in most years with salaries and benefits, at some point you can benchmark a few of those because you have consistency within your contract. When you're going into a negotiation, you no longer have that 5-year workout, and that's our biggest contract right now. Our support contract, that is set for the moment, so we're good there. Our administration contracts are Act 93, but our biggest set of people, that's in a contract negotiation, so we have no set salaries at this point. And also, the Health Consortium has not gave us a set rate for the percentage increase within healthcare. Right now, through this projections, I may mention later, I budgeted 14% within this model, increases in healthcare. So, estimated personnel costs, healthcare rates, once again, have not been locked in. We're still working through the process with all our departments, getting line items in so they are able to budget for their buildings, for their departments. So we are working through that, but we do a percentage increase through that PFM model that you can review when you go through the other attachment on the board. So right now, through our projected model, we have projected expenditures of $115,325,649 with projected revenue of $104,388,017. This leaves us with a current budgetary deficit of $10,937,632. Now, what is important to remember here, the reason for this deficit, as you can see below, we have an $11.011 million capital fund transfer. That's for all the capital fund projects we are budgeting right now for the both HVACs at both schools. That is a big chunk of that $11 million. So if you would remove that capital fund transfer and we were going to issue that or not do those projects, we would show an operational surplus. Slight, but we would still show one. So just subtract that capital fund transfer out
So-
there to see what you're operationally at.
Hey, Chris,
Yes.
just because you mentioned the number, I wanted to ask the board to remember that number, because I'm going to, in a few minutes, I'm going to reference another attachment, and I'm going to come back to that number. So just remember that number he mentioned, 11,011,699. Okay? I just wanted to put a little pin in that number. Thank you, Chris.
No problem. This was also in the prior presentation. This shows how we allocate our fund balance. As you can see, the big number we have assigned for capital improvements, that is within our general fund balance of this 36.386, where we have around $9 million in our capital reserve to total $45 million. When you look at the unassigned fund balance, it's $7.598 million. Based on PDE regulation, school code, we have to be under the 7.99%. That's why you see these assignments. As you look through, we did explain those in the last meeting. If there's any questions on these, please let me know. Okay, so we're going to get into revenue now. Please stop me at any point.
I'd say about 7 or 8 minutes.
Okay. So this just gives you the breakout of our revenue. As you can see, the percentages, a majority of our percentage there is local revenue, which is based mostly in real estate taxes. You can see that is 63.4% of the bucket. Overall, local revenue is 78.8%, state 20.6%, with the majority of the state revenue being our basic education funding, our Social Security reimbursement, and our PSERS reimbursement. Federal grant revenue will fall based on the fact there is no more ESSERS money to expend within the district. Very minimal, if any, carries forward, probably less than 20,000, but I believe we will spend through that by the end of the year. So you can see that 0.5% in federal revenue, and that is attached to certain aspects of how you have to spend. So we have a couple quick factors with revenue. I would go to the main one right at the moment is, as I said earlier, our tax assessment has remained pretty stagnant this year. That is based on some of the common level ratio appeals that you have probably seen through some communication we've had. What's happening usually at districts such as ours, we have massive growth. People are moving in, new housing plans and such. Well, that growth is now being matched by that common level.
We can
ratio
talk
where
more
it says-
about that in School
Got it.
Finance 101, so that'd be a great place to get into common level ratio, just to keep us
Perfect.
moving tonight, yeah.
And then we've also had some nice additions to our EIT tax to reports from Keystone Collections.
I do have a question on the common level ratio, and I know we'll cover it later. Because that is an unknown, how do we look at like a worst case scenario, best case scenario, as far as maybe a decrease, looking beyond 2024? How do we plan for that?
I think overall, you have to watch the previous, it was very unknown prior when we got into last year, where several of us business managers had been communicating to try to figure out how to expect, is there a formula? And we all had different concepts around that based on overall when a home was bought, certain factors such as that. What I have done to keep communication open is speak to some of my fellow finance directors to see how their property is moving, to see how they're budgeting and such. And as I said, fortunately, we're in a district with growth. So from my understanding and keeping communications open with Jordan Tax, who handles our refunds and such based on the reassessments, it's just keeping an open line of communication.
So I guess I would, let me answer it more concisely, and Chris, you can correct me if I'm wrong. We have seen a year-over-year increase in the overall tax base of the district. So we've seen that growth in revenue through a strengthening, growing commercial and residential tax base. We would expect this to flatten that year-over-year growth. I'm not sure that we're going to see in any 1 year or 6 month period, like exactly what happens to that in the long term, but we're going to be able to monitor sort of that overall trend in revenue over a little bit of time to understand what the implications are. But it's a crystal ball. It's too much to ask, but it's not going to happen so quickly. In our case, we're a little bit insulated that I think it's a decision point. It's just something to have strategically in our mind.
Yes.
Fair? Tony, agree? Okay.
Fair. And then I'll just run through this very quickly. We did go over with the state revenue, our basic education fund, those buckets. The biggest issue with the state budget is trying to project that also. Last year, it's due by June 30th. Last year, we didn't get the governor's finalized budget till December 30th. And they're reviewing the basic education fair funding formula, which I believe Mrs. Kirk mentioned last year. So that could be very much an unknown. So if I go to the next page, you can see that 0.5% that I discussed with the federal grant revenue. As you can see, that follows along with most of the title funding, IDEA. With that funding, that goes through our local revenue. That's a bigger block. We received $793,000. Dr. Cozella, she did a nice job where she combined our title funds to pay for our title teachers as those expenses grow as people move through our salary scale. And you can see the others, the IDEB, the school-based access program, and then our food service fund with our reimbursement for our meals and such. Go through our expenditures, see if there's any major points to hit on. I think the biggest key for this is this pie chart when we discuss our expenditures. As you look at these percentages, the main is salary and benefits at 63%. You can see our fund transfers and our capital reserve. That makes up 9.5% of this budget. Now, if you remove that fund transfer as we discussed, you're looking at salary more to 69.6. Other services is our next big
Just
hit.
in the interest of time, Chris, so
Cruise by.
people, debt, capital funding, transportation, those are the big rocks that go into the expenditure bucket.
Yes. So, most importantly,
So, hey guys, just again, as we've talked, we're running out of time, but I'd like to ask Barb to do something because I don't want to rush through something that I think will help look at things from a big picture. So Barb, in the agenda for item 2.02, there's an attachment. It's the last one, titled Revenue Impact of 2017 Millage Increase.
Yep.
Could you move that? Could you also attach that to the combined meeting agenda under the finance item that discusses the recap of this meeting, and I will address that attachment in person in more detail. I think it will level set everyone. It'll kind of recalibrate everyone's head about where we are with this budget that we're talking about.
Sure will.
Thank you. Okay, thank you, Chris.
No problem. Sean, can you flip that?
So
And I can wrap up.
I think with the time left, Chris, do you want to, I would like to shift, and I'll defer to you because it's hard for me to tell.
I can wrap up in 2 minutes. How about
you
that?
were, okay, and then we'll go to item 2.03 because I want to get into that too.
If we cruise through the rest of these slides, ultimately discussed this earlier, PSER's down. It's actually went down the past 2 years, but still at a very high level. And then the biggest unknown factor outside of not having wages settled within our professional contract is the health consortium, as we haven't finalized that percentage, but we have budgeted conservatively that for the in this projection. So you can see this is from the benchmarking retirement planning. That explains the PSERs and the PSERs rate, so you can see the flow of how that has went up and down and increased. Voting levels, spending, we always use this as a benchmark to show our departments are spending responsibly, as the dark gray line is the budget, the light gray line is the actual. As I'm sure everybody's heard enough about the Act 1 index of 2006. That pretty much gets into our homestead, farmstead letters that everybody gets throughout the district. So it's based on essentially the revenue we are given from the state based on the state gaming. And then we divide it by the number of households that apply for the Homestead Farmstead Act. What you have to prove that it is a primary residence. Last year, individuals that apply for that, everyone got $217.35 back based off their property tax bill. No matter what the value of your home is, it's even for everybody. It's divided by the number of properties that apply. You can see the history of our millage. We stay very even since 1718. No raises, even though the index rate has went up for us. Per household, important slide, if we were to raise up to the index at a median assessed home within the district of $270,500, it would be $280.78 on each person's tax bill at the median assessed value. That's just an example so you could see how much that would be on someone's tax bill. Next stats, we went through this. Next finance committee, May 6th. June 10th is when we would have, well, May 6th, we would have to adopt the proposed final budget. June 10th, we would adopt tax rates and final budget so we can meet all the parameters of the PDE timeline.
All right, good evening. The next group of slides we're going to talk about is this stadium scoreboard replacement project. It's a continuation of what we started discussing on the 22nd of January during the Buildings and Grounds Joint Governance meeting. So you have the slides in front of you. The agenda is just to kind of show where we're at now, what options are available, what our recommendations are right now, and then give some current examples of where we're kind of looking at to replicate or benchmark off of, and then and open up for discussion and questions, which might have to happen at a later time based on timing tonight. All right, so here's an example, a picture of our current scoreboard. So that current scoreboard is 23 years old. That is the epitome of a fully depreciated asset right there. I mean, that thing has done its job for a lot of years. Parts of the scoreboard don't work anymore, such as the message board. So I've been here for 5 years, and it was down before I got here. So it's we've definitely got our mileage out of this asset. It's worked out well. We have looked ahead and put it in the capital funding plan. We believed at the time it would be in the $400,000 to $500,000 range. There's opportunities across all aspects of the district for the kids to use this. We think it's a great asset. We think it'll be in our action priority matrix, it's going to affect a lot of kids. We understand it's a high dollar item, so we view it as a major project. On here we have possible sponsorships and revenue. So we've learned a lot by looking over the options and the pricing and everything that was available since we talked last. And what we found out that really nobody's going alone on this. So the sponsorships and the revenue are going to have to be an important part of this. And we're going to put, Mr. Geronda and I are going to put a lot of effort into that as well. So I want to let you know that's part of it. This also coincides with some other stadium improvements. So if you want to look at like the other parts of the stadium and kind of understand that everything that we have athletically it's kind of expensive as well. So the track depreciates at about $30,000 to $40,000 a year. The turf is about a $50,000 a year depreciation, just because those assets don't last forever. They are expensive. This is another aspect of our total athletic program and our educational program, so we view it as an important piece. All right, so we wanted to go over what options are available and just kind of let you know, starting from the beginning, like what we currently have. If we could buy the same scoreboard today, in today's dollars, it would be about $100,000. To go even further one back, if we want to remove the message center from that, it's about $43,000 for the steel structure and the metal with just the fixed digits. So the ones on the left on the bottom, those are all fixed digits on a hard board made out of metal. As you start moving across the spectrum, the continuum to the right is when you pick up video board capability. And the cheapest video board capability that you can buy today starts at $150,000. And you can see that that one would be hard to view from the stands, as you've got that small picture in the middle and you've got the advertising boards on the left and right. So those are not part of the video. The furthest one on the right is really where you start getting into usable video board space that could be seen from the stands and used. This next slide shows the furthest end of the continuum, the better and the best options, and that starts out with an 18 by 32 video board, and then the one on the right is an example of a 23 by 40. And those boards are complete video capability. Even though the one on the right has digits and everything on it, that is all digital matrix board that could be the screen. It could be a replay on the entire board on the right. So, we're not looking to go bigger and better than everyone else has. We're looking for a nice option that fits our stadium, goes along with all the other nice parts of the venue that we have, and also with being cost conscious. But you can see the numbers at the bottom. They have increased now to around the 450 range to get into the small board, and then the big board, 666 to first start. So we do realize that it is an expensive asset. So this just recaps for everyone the whole spectrum. We don't view the two on the left as really viable alternatives. They don't really meet our needs, especially with the video board being out of date and the small screen. So the ones on the right are really ones that we see that other peer schools in 5A, in the typical size of our school. These are the options that are available. And out of the three, we really think that option B fits our venue, our school, our view that we want to go with something that's modern but not over the top. We felt that option A encapsulates some old technology with that hard board on the bottom of it. And we also saw some of other schools that are upgrading are going away from option A and upgrading to option B or C already. So we feel that that would be a step backwards. So in this respect, we think that the size, the viewability would be good for the distances that we're looking at. It's flexible enough that the full matrix video board gives us the flexibility to show advertising as well as any kind of promotional videos we have for school activities. You can see there the graduation could be simulcast on there. It's just our live video feed. So there's a lot of options available. We do realize that the price is in the, you know, the $450,000 range there to start. As we spoke a little bit on the 22nd of January, we evaluated an alternate location. So we're calling that alternate one on our on the quotes that are coming in, and that alternate location is on the side closest to the access road and the annex for the sports annex on the far side, on the visitor side. And these are just some examples of what that would look like. The scoreboard would be raised for better viewing. And it also provides us the ability not to have to drive on the track surface to ever do maintenance on the scoreboard again. So we think it would save us some money down the road as far as not having to buy protection for the track or possible damage to the track itself. Our second and final alternate was to look into what an increased resolution would look like. So these are two examples of resolution on current fields that have upgraded to this video board technology. The one on the left has a lower resolution, and on the slides you can actually see the actual pixelation on that screen, or the one on the right you can actually read 2022 Field Hockey Championships, and the letters are much more crisp. And there's an associated cost with that listed at the bottom of the screen.
So Jeff, I'm sorry,
Yep.
it's 6:57. I just want to do a time check. You know, we could just, if there's anything else to present, we can include that in the combined meeting 2 under the recap of this meeting.
Okay.
I just didn't want to go I don't want to go long, that's all.
Sure.
Yeah.
All right, so I'll just recap on this slide then.
Yeah.
Is we looked at all options. We feel that option B with alternate 1 and 2 is really where we need to be. We understand that the cost in the 525 to 560 range is higher than we expected initially. We're continuing to revise quotes and get some quotes, you know, try to get some better numbers. But we also realize that a part of this is got to be part of our plan to do either advertising or getting some other folks to sponsor the board. So we're looking into that pretty hard. And these are just some examples. So I can go over this again later now that we're out of time. But if there are any questions on this, I'm available to answer anything.
I have one question. So the current, I just want to be clear on this. So the current scoreboard that we have is in working order with the exception of the messaging part of the scoreboard?
And it is, yes.
Okay, and have you looked at a cost for repair? Is that able to be repaired, the messaging part?
So I've looked into that too. So if we wanted to go back and repaint it and look at the digits and things like that, that could be a short-term solution. I really feel that moving to this video board technology is something that we're going to do sooner or later. We could spend some money to make the current one last a little longer if that's a decision that you all want to make. But yeah, that's available as well.
Okay, great question, Lisa. Thank you for that.
I did have a couple
Jeff,
more
thank
questions,
you.
but should I wait till the later in the
You
next
said-
meeting? Okay, yeah, but just make note that I had some questions.
All right.
Okay.
I'm sorry,
No, go ahead,
I
Mark.
didn't hear who-
Nope.
Sorry, Mark, I didn't.
Go ahead, Mark. We're okay.
Okay. All right, so why don't we move to item 4.01, recognition of visitors. Do we have anyone who would like to speak?
We do not.
Okay, then let's adjourn and we'll see you guys at the combined meeting.